August 2024, an alarm went off, an economic failsafe that had, for decades, been nearly infallible. The Sahm Rule, an unemployment moving average indicator revered for its track record, triggered when the unemployment moving average rose 0.5% above its 12-month low. Historically, this signal was a harbinger of doom. Recessions almost always followed. Wall Street analysts, IMF economists, and market strategists all braced for the inevitable. The recession monster had been spotted, and the models said collapse was coming. Newsrooms across the country plastered headlines warning of a looming economic storm. Every chart showing rising unemployment, debt, and inflation fed the narrative. Social media buzzed with warnings, speculation, and fear. Advisors urged clients to tighten belts, delay investments, and prepare for contraction. For anyone who followed economic cycles, the signs were unmistakable. The U.S. economy should have been on the brink. Yet, something unusual happened. Weeks passed. Months passed. The predicted recession, the one that historical patterns insisted would arrive, simply did not. GDP growth remained positive. Unemployment plateaued instead of skyrocketing. Inflation cooled rather than spiraling. The economy, for all practical purposes, kept moving forward. Experts scratched their heads. It shouldn't be possible, said economists on panels and in interviews. All the indicators point to contraction. This wasn't a minor anomaly. It was a stark contradiction to decades of economic history, a puzzle that demanded explanation. How could the fail-safe alarm trigger, signaling an almost guaranteed downturn, and yet the economy remain afloat? The story of 2024 to 2026 is not one of luck. It's a tale of hidden resilience, adaptive forces, and unexpected pillars of stability that defied traditional predictions. To understand this, we need to look at why experts were scared, why models said the economy should collapse, and most importantly, why it didn't. It's a story that blends technological innovation, concentrated consumer power, corporate agility, and human behavior into a delicate balancing act. A virtuous but fragile cycle that kept the system from tipping. By the end of this exploration, you'll see that the U.S. economy's survival wasn't just about numbers or policy. It was about hidden strengths, strategic adaptation, and subtle forces that models often overlook. And perhaps most importantly, it challenges the way we think about risk, collapse, and resilience in a complex modern economy. In late 2024, economists were gripping their calculators with white-knuckled intensity. Headlines screamed about tariffs, inflation, and a looming trade disaster. By December, the average U.S. tariff rate had soared from 2.4% to roughly 16.8%, a six-fold jump in just over a year. For anyone paying attention, this wasn't just numbers on a spreadsheet. It was a seismic shock to the lifeblood of the U.S. economy, trade. Experts warned that imports would dry up, exports would stumble, and prices on everyday goods could spike, dragging inflation back into double digits. Wall Street simulations and IMF-style models showed a clear path to a contraction. The recession monster seemed not only alive, but hungry. What made this period especially alarming was the breadth of the tariff impact. It wasn't limited to a single sector. Electronics, automotive, and energy markets all faced sudden cost hikes, forcing companies to scramble or risk collapse. Analysts warned that companies dependent on global supply chains would face massive disruptions, and with labor markets already tight, layoffs could ripple quickly. The combination of rising costs and potential revenue drops painted a bleak picture. Beyond business numbers, the human angle intensified the fear. American households already juggling record-level debt were on edge. Consumer confidence surveys dropped sharply in the summer of 2025, feeding a feedback loop that often predicts recession. Economists saw these surveys as warning lights, like gauges on a dashboard turning red. The The scenario looked almost textbook: rising costs, slowing demand, and panic building beneath the surface. Yet, even as the tariff shock dominated headlines and professional models, a quiet tension emerged. Many experts admitted privately that they had never witnessed such a large-scale, sudden trade barrier without triggering an immediate contraction. It was as if the economy had entered a stress test on steroids, and no one could be certain whether it would pass or shatter. The key takeaway from this stage wasn't just the economic risk, it was the psychological pressure. The combination of unprecedented tariffs and skyrocketing debt painted a future everyone feared, creating a climate in which even cautious investors and analysts assumed a downturn was inevitable. Every indicator screamed caution. Yet, as we'll see in the following sections, the alarm bells, though justified, were about to meet a counterintuitive reality. As 2025 rolled in, another red flag loomed over the American economy: consumer debt. For decades, economists have treated debt accumulation like a canary in a coal mine. Too much, and the economy risks suffocating under its own weight. By mid-2025, U.S. consumer debt had reached an all-time high of $18.59 trillion. Credit card balances, student loans, mortgages, and auto financing all climbed simultaneously, creating what analysts dubbed a flashing yellow light for economic stability. The sheer scale of the debt wasn't the only concern. It was how interconnected and fragile it had become. Rising interest rates meant that even modest monthly payments consumed larger portions of household income. For lower and middle-income Americans, this was a tangible squeeze. Discretionary spending declined and saving became nearly impossible. The paradox was stark. While debt fueled growth by enabling spending, it also made the economy increasingly dependent on continued cash flow from consumers who were financially stretched. Financial forecasters warned that this combination, high debt, rising interest rates, and tariff shocks, could be catastrophic. A single major default wave could trigger a domino effect, sending banks into panic and freezing credit markets, much like 2008. In models run by the IMF and leading financial institutions, debt levels of this magnitude often presaged recession, particularly when paired with inflationary shocks. Every historical precedent pointed to one likely outcome: contraction. But beyond the numbers, the debt mountain had a psychological dimension. Americans were aware of their obligations, and media coverage amplified the anxiety. Headlines screamed about ballooning balances and unpayable loans, fueling a sense that a collapse was just around the corner. The paradox of thrift, the idea that everyone tightening their belts simultaneously can tank an economy, loomed large in economists' warnings. If households pulled back on spending en masse, the very engine of U.S. growth would stall. Interestingly, while the statistics were daunting, a subtle tension was building beneath the surface. Despite the record debt, certain segments of the population, particularly high-net-worth households, remained largely insulated. They continued to spend, invest, and consume, creating an unseen pillar of stability that would prove crucial. The economy, in other words, had a hidden support structure that traditional models often overlooked. A concentrated group of consumers whose financial resilience acted as a buffer against the widespread fear triggered by the debt mountain. This was the first hint that while alarms were ringing, the U.S. economy's collapse might not be as inevitable as the models suggested. Alongside tariffs and skyrocketing debt, the U.S. labor market presented another perplexing challenge. Economists referred to it as the no hiring, no firing trap. A precarious situation where companies weren't aggressively hiring due to uncertainty, but at the same time, layoffs remained restrained. This created a paradoxical environment. For those already employed, job security seemed deceptively stable, yet for job seekers, opportunities were scarce. It was a labor limbo that raised alarm bells across economic circles. Why did this happen? First, businesses faced mounting pressures from multiple fronts. Tariffs increased costs, consumer demand was uneven due to debt stress, and inflation persisted in certain sectors. Hiring new employees became a risk. Expanding payroll under such conditions could backfire if revenue unexpectedly dropped. Conversely, firing staff was equally fraught. Layoffs could disrupt operations, weaken morale, or trigger public relations blowback, especially amid already tense economic headlines. As a result, companies opted for stasis over action, freezing employment dynamics. The implications were widespread. Job openings stagnated and wage growth became uneven. High-paying tech and AI sectors continued to expand, while traditional industries lacked. This duality created a tension economists described as the two-speed labor market, a highly resilient niche coexisting with a stagnant, cautious majority. Analysts feared this could suppress consumer confidence further because people outside the resilient niche might curtail spending, reinforcing recessionary pressures. At the same time, the labor trap had subtle knock-on effects on innovation and productivity. Companies reluctant to expand their teams had fewer resources to adapt to challenges like supply chain shocks or tariffs. Economists projected that if the pattern persisted, the economy could enter a stagnant growth phase where productivity gains slowed and inflationary pressures persisted, a classic recipe for a slow-motion recession. Yet, even amid these fears, cracks in the alarmist narrative began to appear. Certain sectors, particularly those leveraging emerging AI technologies, not only survived but thrived. Corporations that restructured workflows, invested in automation, or pivoted operations effectively sidestepped the constraints of the labor trap. The very existence of a two-tiered economy hinted at resilience within fragility. While many felt trapped, others found ways to power forward, quietly offsetting the broader risks that models and pundits predicted would lead to collapse. The labor trap, in other words, highlighted the fragile yet adaptive nature of the U.S. workforce. It reinforced the sense that while alarms were warranted, the economy was quietly supported by pockets of strategic agility, an early clue that the collapse everyone feared might never materialize. As the dust settled on tariffs, debt, and labor anxieties, a surprising force began to reshape the economic landscape: artificial intelligence. By early 2025, AI-related investments were no longer a niche tech story. They were a critical pillar of U.S. GDP growth, contributing roughly 1/3 of the increase in output during the first quarter alone. What had initially seemed like a futuristic experiment became a massive supply-side counterweight to the economic headwinds experts had feared. The impact of AI was multifaceted. Corporations deployed intelligent automation to streamline production, reduce costs, and reconfigure supply chains disrupted by tariffs. In industries from manufacturing to logistics, AI systems optimized operations with a precision that humans alone couldn't match. The result was operational resilience, allowing companies to absorb shocks that traditional economic models predicted would trigger layoffs and closures. Beyond efficiency, AI also fueled investment cycles. Venture capital and corporate funding surged into AI-driven startups and initiatives, creating jobs and stimulating spending in associated sectors. Even industries seemingly unrelated to technology benefited indirectly. Logistics, warehousing, and energy sectors experienced growth due to AI-powered efficiency gains, while financial markets responded positively to the promise of higher productivity and profits. The societal implications were equally profound. While fear of job displacement loomed large, the immediate effect was paradoxical. AI freed human labor from repetitive tasks, allowing workers to focus on higher value roles and innovation. This shift enhanced productivity without triggering the mass layoffs that economists had feared, contradicting predictions based solely on the labor trap or debt indicators. Perhaps most importantly, AI created what analysts began calling a virtuous but fragile cycle. Increased productivity fueled investment, investment stimulated spending, and spending reinforced growth, despite mounting debt, tariffs, and labor stagnation. The cycle was virtuous because it promoted expansion under adverse conditions, but fragile because it relied heavily on continued adoption, funding, and technological efficiency. Any disruption, regulatory missteps, tech failures, or geopolitical interference could still threaten this delicate equilibrium. For the first time in this narrative of looming collapse, there was a clear reason why the US economy might refuse to follow historical recession patterns. AI wasn't just a band-aid, it was a structural engine that counteracted multiple collapse catalysts simultaneously. It revealed that innovation, when scaled and strategically applied, could rewrite the rules of economic predictability. The AI engines weren't infallible, but they were potent enough to stabilize growth in a way that traditional models hadn't anticipated. This was the first of the three pillars holding up the economy when everyone expected it to fall. While AI powered efficiency and investment, the second pillar of economic resilience was rooted not in technology, but in human behavior, specifically the spending patterns of the top 40% of US households. These households, which collectively account for 62% of all consumer spending, proved to be unexpectedly indomitable amid the financial storm. Even as headlines screamed about debt, tariffs, and labor traps, their consumption remained largely unshaken, acting as a hidden anchor for the economy. The disparity between the top 40% and the remaining 60% created what economists call a two-track consumer reality. Lower-income families felt the squeeze of debt, inflation, and job market constraints acutely, adjusting spending and curbing discretionary purchases. For them, the financial alarms were real and immediate. Yet the top 40%, shielded by high asset valuations, equity gains, and relatively robust incomes, continued to spend confidently. Luxury goods, real estate transactions, travel, and services remained robust, keeping money circulating through the economy even as widespread anxiety persisted. This dynamic was critical. Economists often underestimate the stabilizing power of a concentrated spending base. While aggregate metrics like consumer confidence surveys appeared weak, the actual cash flow from this resilient segment prevented the contraction spiral that typically accompanies high debt and economic uncertainty. It was as if a hidden engine was quietly running under the radar, sustaining retail sales, service sectors, and even tax revenues that might otherwise have faltered. The top 40% also played a subtle role in investor sentiment. Stock markets, buoyed by sustained high net worth spending and corporate profits, maintained valuations that reinforced wealth effects. People saw portfolios rising and felt wealthier, encouraging continued spending and investment. The paradox was striking. While many feared collapse, the concentrated strength of a smaller group of households provided a counterbalance powerful enough to keep the economy afloat. However, this pillar came with a built-in fragility. Heavy reliance on a relatively small segment of the population meant that any sudden shock, market volatility, policy changes, or unforeseen crises could quickly ripple through the broader economy. It was a virtuous but fragile cycle. Spending fueled growth, growth reinforced confidence, and confidence encouraged further spending. But the system's stability depended disproportionately on the resilience of a minority. By mid-2025, it became clear that this human factor, consumption by the indomitable 40%, was as crucial as AI engines in explaining why the US economy defied recession forecasts. In combination, these pillars demonstrated that economic resilience is rarely uniform. It often rests on concentrated, surprisingly adaptive forces. The third pillar holding up the US economy was not households or technology, it was corporate adaptability.
While tariffs, labor constraints, and debt painted a picture of imminent collapse, businesses across the nation demonstrated a level of ingenuity that defied conventional forecasts. Instead of buckling under pressure, companies restructured, hedged, and reconfigured supply chains to absorb shocks. Tariffs, once feared as a hammer to production and trade, became a catalyst for strategic innovation. Companies diversified sourcing, shifted manufacturing to more favorable regions, and leveraged advanced logistics to minimize cost increases. Rather than simply passing tariffs on to consumers, they used dynamic pricing, automation, and bulk procurement to mitigate disruptions. This agility created a cushion that traditional economic models rarely account for, allowing firms to continue operating and even thriving under circumstances that historically triggered contraction. Beyond logistics, firms embraced technology, not just for efficiency but for survival. AI-powered forecasting allowed companies to anticipate supply shortages and adjust production cycles in real time. Retailers rebalanced inventory, manufacturers optimized production lines, and financial institutions restructured lending and risk models to adapt to rapidly changing conditions. Every sector became a microcosm of flexibility, demonstrating how proactive adaptation can neutralize structural shocks that otherwise would lead to layoffs, closures, or market panic. This corporate resilience also reinforced the other two pillars. AI engines were implemented at scale because companies were willing to invest in them despite uncertainty. The top 40% of consumers continued spending because businesses maintained operations, provided products, and avoided mass layoffs that might otherwise have curtailed confidence. In effect, corporate agility amplified the stabilizing effects of both AI and resilient households, creating a system of interconnected supports that defied the predictions of pessimistic models. Yet, as with the other pillars, fragility remained. The same strategies that shielded businesses depended heavily on accurate forecasting, sufficient liquidity, and continued investment. Any misstep, unexpected policy change, market shock, or supply chain failure could have reverberated quickly. In other words, while corporate agility helped prevent collapse, it did so within a virtuous but fragile cycle, reinforcing the overarching theme of cautious optimism. By the end of 2025, it was clear that these three pillars, AI engines, the indomitable 40%, and corporate agility, had combined to produce an outcome few economists predicted. The recession monster never materialized, not because the risks were absent, but because the system found hidden buffers and adaptive forces that traditional models often overlook. The economy had survived against the odds, offering a lesson in the nuanced interplay between innovation, wealth distribution, and strategic corporate behavior. So, what does all this mean for the average American watching the headlines in 2024 and 2025? While experts predicted doom, the economy quietly defied expectations, achieving what many would call a soft landing, weaker than pre-pandemic levels but refusing to collapse. The lesson lies in a subtle human and behavioral factor often overlooked: the paradox of thrift. If every household had panicked in response to rising debt, tariffs, or labor market uncertainty, the collapse might have been self-fulfilling. People would have cut spending, businesses would have curtailed investment, and the fragile system would have buckled under its own fear. Instead, Americans kept moving, investing cautiously, spending selectively, and maintaining a rhythm that allowed the economy to adjust rather than implode. This human behavior, combined with AI-driven productivity, resilient top-tier consumers, and adaptive corporate strategies, created a virtuous but fragile cycle. Enough momentum to sustain growth, yet dependent on precise balances. It's tempting to label the US economy as simply resilient, but nuance matters. Its survival was not automatic or guaranteed. The reality is that the economy leaned heavily on a few narrow pillars: technological innovation, concentrated consumer spending, and corporate agility. While these factors collectively prevented recession, they also reveal a system that is resilient but reliant, where stability is concentrated rather than evenly distributed. As 2026 unfolds, the question remains, can these pillars continue to hold under new challenges, or will cracks begin to appear in unexpected places? What's clear is that the U.S. economy's performance in the past 2 years defies simple narratives. It's a story of ingenuity, adaptation, and the often underestimated role of human behavior in economic outcomes. In the end, the recession monster didn't bite, not because the danger vanished, but because hidden forces, AI, spending power, corporate strategy, and cautious human behavior combined to keep the system standing. The economy survived, but the cycle remains fragile. How long it lasts and whether it can withstand future shocks is a story still being written.